Thanks, Don, and welcome everyone to Peyto's annual general meeting today. In the room today, we've got a lot of our Peyto team, in fact, I think the entire staff of Peyto, and afterwards we've got some refreshments outside, so please feel free to mingle with the Peyto staff, grab one of them, ask them questions about what we're doing these days and how we're doing. I'm sure they'd be more than happy to talk about Peyto with you. But before we get to that, I'd like to jump up on my soapbox and talk a little bit about Peyto. I think everyone in the room is relatively familiar with Peyto. We've got employees and we've got shareholders, we've got bankers, analysts. Everyone I recognize, I think, knows Peyto pretty well. So I thought today we could do something a little less formal than our usual formal presentation. And so adopted a little bit of an informal presentation today. First, a disclaimer, though, about forward-looking statements that I'll read out loud to you. I'm going to tell you about my vision of Peyto's future today. I'll also tell you where I think commodity prices are going to go. These, of course, are called forward-looking statements. I'm being truthful and using everything I know about Peyto in the industry to predict the future, but I will likely be wrong on both accounts. Oil and gas exploration and production is, of course, a risky business. Do your homework before making any investment, and, of course, don't blame me if it doesn't work out. All right, well, we got that out of the way. PEY.TO. In the fall of 2014, Peyto celebrated its 16th birthday. We are now officially in our 17th year of operations. And I've been here for 14 of those 17 years, which is over half of my career in the industry. And I can tell you that I'm extremely proud to be associated with this Peyto team, to work with these people, and really, just overjoyed to be part of an organization which I believe to be one of the most successful oil and gas businesses in Canada. If we look back at all the companies that were on the Toronto Stock Exchange for the last 16 years, that had that same 16-year history, Peyto sits number one in total return. Let me say that again. Of all the companies that were traded for the last 16 years on the TSX, there were 152 of them in total. Peyto has delivered the highest total return of any of them, regardless of industry. So, from an investor standpoint, we're not just the most successful oil and gas business in Canada, we're the most successful business in Canada over that period. Of the other E&Ps listed, Vermilion was a distant second in 9th position, ARC a distant third in 20th, and C&Q even further back in 34th. And that also means that if you managed to put your money to work in Peyto in 1998 and you left it there, it's worth a hell of a lot more today. $1,000 in Peyto in 1998 is worth close to $700,000 today. Or your $1,000 would have compounded at 50% every year for 16 years. Basically, we're doubling your money every year and a half. And even if you just managed to join us recently, say in the last 5 years since we've been drilling with horizontal wells, May 2010 until now, your money has already tripled or compounded at 24% per year for each of the last 5 years. These days we're doubling your money about every 3 years, so I guess we're slowing down a little bit with old age. But still, that is incredible. And it's one of the reasons I get asked so often by investors, how do you do it? What is the secret? What is it that allows Peyto to deliver such impressive returns year in and year out? What is the X factor? What is the secret sauce? What is Peyto's competitive advantage? And quite frankly, how do you do it with so few people? So I thought today that we could talk for a little bit about how Peyto works, how we do it. And I think, personally, a lot of how we work stems back to when we started, or rather when Don started Peyto, if he'll indulge me to tell the story. When Don started Peyto, he'd already worked for several other oil and gas companies, seen what they did well and what they didn't do well, and he decided early on not to follow in the footsteps of others. Generally speaking, a lot of them made bad decisions. So he decided right from day one that we wouldn't do what others did. And also when he started Peyto, he didn't have a lot of capital to work with. He wasn't handed some $500 million private equity capital pool. He had to convince family and friends to invest in Peyto. He had to put all of his own capital into Peyto. And so right from day one, our shareholders were not an opportunity, they were our partners in this venture. And when you're using family and friends' money, it's pretty important that you generate a profit. So right from day one, it was about generating a return on the money, not trying to make their money our money. And you know, if it's family and friends' money, you can't afford to lose it. So you look for the lowest possible risk opportunities you can find. And even after you might have been successful with your first venture, generating a little bit of profit, you don't get a free pass. You have to be able to predict and repeat what you're going to get. And so the investment opportunities you get next have to deliver the same result. So maybe it's not surprising that the foundation for our strategy became what it is today. We invest in our own ideas. And we have a lot of them. Over the last 16 years, we've come up with over 3,000 drilling locations. We build it ourselves. We've drilled over 1,000 wells in the Alberta Deep Basin. We've built over 1,000 kilometers of pipelines. We've built 8 gas plants with over half a BCF a day of processing capacity. And we operate it all ourselves, or virtually all of it, 99% of it, because we want to control it. And our primary focus for every dollar of the $4.2 billion of capital that we've invested is to generate the maximum possible return on it that we could. And because this industry is ruthless with constant change, we knew that we couldn't get fat or complacent or we would never last. These aren't just words on a page. Well, they are, but this is what we believe at Peyto. This is what drives our decisions. This is what drives our behavior. And in part, I think this is exactly why we've been so successful. So we fast forward 16 years to where we are today with one of the premier asset bases in the industry, one that we built ourselves from our ideas. It's concentrated in liquids-rich, sweet resource plays in the Alberta Deep Basin. It's an asset base that we own, that we control, and that we operate. And it's one where we don't have any risk of wells watering out unexpectedly. And one that we can predict with increasing confidence what kind of returns we're going to get. And every year we keep coming up with more ideas, more places to drill, more places to invest shareholders' capital to get that maximum possible return. We're now up to almost 2,000 internally identified locations to choose from. And considering we're only drilling 125 wells a year, that's close to 15 years of future inventory, more than we've ever had before. And every year over the last several years, in fact, for every well we drill, we come up with 2 more locations. So this list is expanding, it's growing. And you can bet that Dave and his team are going to find a lot more locations in the time it takes us to drill another 1,900 wells. But of course, locations don't make us any money. We know that we have to go out and successfully execute. We have to successfully drill. We have to successfully complete. We have to successfully tie in these locations in order to start generating a return for shareholders. And that's what we've done, well, at least for the first 1,000 of these locations. And even after we've drilled all the inventory that we have, our land base is still only going to be 20% developed. So there's lots more opportunity beyond that. But we have to remember, drilling gas wells is really only a means to an end. We're in a business, and the business of Peyto is making money. And there's no question that we've made a lot of it. And I think it's easy to see just how profitable Peyto's been. Over the last 15 years, average cost to build it averaged $1.95 an MCFE. Average production cost was again $1.95 an MCFE, and that's all in. Royalties, op costs, transportation, G&A, interest, everything. And we sold it on average for $6.65 an MCFE, generating $2.75 of profit. We made approximately 40%. Even last year, the math looks very similar. In a year where we invested more capital than ever before, close to $700 million. And arguably, I think we're still in a bit of a low in the commodity price cycle. But we spent $2.25 to build it, $1.08 to produce it, and sold it for $5.04, leaving $1.71 in profit, or 34%. That's still really good. Every year of our history, we've built it and produced it for less than what we sold it for, even through the lows of the commodity price cycle. That's what you call a profitable business. That's what you call a low-cost business. And we're hoping this year to be even lower cost, to drive down those capital costs so our F&D costs are even lower, drive down those operating costs so our production costs are even lower, leaving more room for profit. And the result of all that activity does yield growth. We've had growth in our production, growth in our reserves, growth in our cash flow, all on a per-share basis. And it's spectacular growth at times. But remember, it's profitable growth. We have to be very careful not to chase growth. That's what the other guys do. That's what gets them in so much trouble. Growth has to be the resultant. Profit and return has to be the goal. That has to be the focus at Peyto. You know, nowhere in our strategy is the word growth. I mean, do you see the word growth anywhere? No, but you do see two key words: invest and return. I mean, here's a couple examples. Us and our nearest competitor in the Deep Basin, both with pretty spectacular growth on a production per share basis over the last 3 years. And clearly the blue line looks better than the red line until you look at the math. In the top case, the cost to build it and produce it is greater than what they sold it for. So you have to ask yourself, what's the point of all this growth? It's unprofitable growth. They don't actually make any money. So who cares about the growth? Whereas the bottom line looks pretty good too, but there's real profit there. We've built it and produced it for less than what we sold it for. So there's real profit to go with the growth. It's profitable growth. There's a big difference. I mean, here's another one, a new entrant into the Deep Basin, even more spectacular growth and even more spectacularly unprofitable. So I ask you again, why should you care about the growth? I mean, as one critic put it, they have an infinite supply of negative return opportunities they can use to grow with. Well, that's wonderful. At Peyto, we're not interested in profitless growth. We focus on return, investing shareholders' capital to generate the maximum possible return for those same shareholders. Peyto's average return on equity over the last 16 years is 34%. Our average return on capital employed, 18%. And even last year, in a lower gas price environment, arguably, we delivered 21% and 13%. You focus on returns. That's how you get to be number one over 16 years. That's how we do it at Peyto. That's how Peyto works. And sadly, it's a fairly unique way of thinking in our industry. So we've been in business 16 years now. We've drilled over 1,000 wells in the Alberta Deep Basin. What else have we learned? Well, I think one of the biggest things we've learned is that our business isn't based on a rigid plan. It's based on a strategic foundation that never changes. It's based on a consistent strategy that everyone in this room buys into. And we've learned we can have plans. We have them every year. We have a budget in the fall. We have drilling schedules. But those plans are going to change. So our plan has to stay very fluid. We have to stay very flexible at Peyto. Because we sure know the commodity prices are going to change. I think one thing we know for sure is that commodity prices are getting more and more volatile. We also know that they tend to be cyclical. They cycle up and down, and the industry activity tends to follow them. When the commodity prices are up, the industry's busy. When they're down, the industry's doing nothing. And I think the biggest challenge for a lot of companies in our industry is to deal with that volatility. As investors, we want to look for companies that can survive the cycles, or better yet, take advantage of them. Okay, so if we all agree that commodity prices are cyclical and the behavior of the industry is to be active when the prices are high and cash is plentiful and do nothing when the prices are weak, when do you think is the best time from a returns perspective to deploy capital in the industry? I believe the best time is actually at the bottom of the commodity price cycle, not at the top. Because at the bottom is when activity levels are their lowest and costs are at their lowest, because you're locking in those capital costs. At the top of the cycle, when the industry is typically busy and companies are running their project economics, they're usually using a very strong commodity price forecast to justify the high service costs. But then the commodity prices never stay there. So the returns they think they're going to get end up being something less. Whereas at the bottom of the commodity price cycle, you're locking in the costs when they're the lowest. And so your forecast returns at the time are likely going to end up actually being better. So we want to be most active at the bottom of the cycle, not at the top. The rub, of course, is that very few companies have any cash at the bottom of the commodity price cycle. So in order to have a lot of cash, you have to have the best margins. You have to be the lowest cost producer. Then you can invest counter-cyclical to the industry and get the best returns. And if you're successful deploying capital counter-cyclical to this industry, what do you think the resultant growth profile looks like? Well, unfortunately, it won't be that nice linear growth profile that we as investors always want. It's going to be lumpy. It's going to have periods of dramatic, more profitable growth, followed by periods of subdued growth. But over the long term, the overall rate of profitable growth is going to be better than for a company that tries to manage a growth profile through the cycles. I mean, does this look familiar? Peyto's real profitable growth profile exhibits that same lumpy shape. Now, we also said that in order to invest counter-cyclical to the industry, you had to be the lowest cost producer. And everybody knows that Peyto clearly is the low cost producer. And our low cost advantage comes primarily from our operating costs. These are achieved because we own and control our own infrastructure, because we deliberately only build low cost assets, and because we choose to not buy other people's high cost assets. I mean, investors are always asking me, how is it you achieve such low costs? And I think one of the best ways that I can really describe how Peyto gets its low cost is to compare it to building your own home, for instance. If anyone in this room has ever built their own home and you were around for the construction, you were around when they dug the hole, when the cribbers framed the foundation, the cement got poured, the framers show up, put the floor on, the walls up, the roof on, and then the electrician shows up and runs the wires through all the walls, the plumber runs all the pipe through the walls, and then the walls get drywalled and taped and painted and finished, and you move in, and if in the first week you spring a leak or you've got a short, you know exactly where to look to fix the problem because you were there during the construction of it. So you can fix it cheaply and quickly and easily. Whereas if you've bought your home off the market and in the first week you've got a short or a leak, you don't know where to look. And so you scramble around hiring plumbers and electricians and builders to come in and help you fix the problem. And it takes a lot longer. It takes more people and it takes more money. That's the difference between the asset that we have, that we built ourselves, and the ones that most of the industry has. That's how we get this low-cost advantage. Now remember, profitable growth is what we as investors are looking for. And profit is what also drives real and sustainable income for shareholders. Let's think about that for a minute. If you have a capital project to invest in, there's really only three sources of capital for a public E&P company. There's cash flow, there's equity, there's debt. And for some companies, the cost of capital is reasonable for those external pieces, and for others, it's really expensive. But if you generate a profit on the capital you invest, then you should have something you can share with your shareholders to pay dividends out of. The problem we have with some companies in our industry that pay dividends, though, is that they don't actually generate any profit. And so they're paying dividends out of cash flow or equity or debt, which are all supposed to be sources of capital. Clearly, that's an unsustainable situation. However, if a company is successful generating a profit, especially one that's greater than the cost of their capital, then they can use those external sources, equity and debt, at times, to actually improve the returns for shareholders, especially if they're using them at the right times in the commodity price cycle like we talked about earlier. And it's out of profits that sustainable dividends come from. Since 2003, Peyto's consistently paid distributions and dividends out of its earnings, out of its profits. That's where they're supposed to come from. That's where Peyto's come from. And that's how we know they're sustainable and they don't cut into the sources of funding for our capital program. Okay, so that's a few things I think that we've picked up along the way over the last 16 years. We know that commodity prices, industry activity are cyclical. They're on, they're off, and we know we don't want to behave like everybody else. We know that the best returns are generated by the lowest cost producers who are investing counter-cyclical to the industry. And we know that we need to see real profits so that Any growth is profitable, and the yields that we pay are sustainable. And so how do we use all that knowledge going forward? Well, I think we know here at Peyto that we have to continue to strive to be the lowest cost producer. Huge advantages come out of being the low cost producer. And we must continue to focus first and foremost and solely on returns and profitability and not on growth. And we have to remember that we're in this for the long term. So let's make decisions that benefit Peyto and its shareholders for the long term. We all in this room know the value of being concentrated. We know the value of being highly focused. And even though we have a big war chest of opportunities right now, we know we have to keep coming up with new ideas, keep being innovative, keep coming up with new opportunities to generate maximum return for our shareholders. So all of that fits consistently with our plans this year. Our plan, as always, will be very fluid, but the strategy won't change. I think gas and oil prices this year are likely going to remain soft. I think industry activity is going to be low, and I think costs are continuing to fall. And that's a perfect opportunity for us to invest capital at Peyto to generate that maximum return for shareholders. So I think we're going to have another record-breaking year from an activity standpoint, and I think we're going to have another record-breaking year from a profitability standpoint. And maybe we even hit 100,000 barrels a day this year, but that is not our goal. Our goal and our focus has to be generating the maximum possible return on the $600 million of shareholder capital that we're investing this year. Anyway, that's enough of me talking. I'm going to get off my soapbox, and thank you all for coming today. I'd be happy to answer any questions you have.